Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week's topic, guys, is when the markets speak the loudest. One of the things I've been getting a lot recently through emails and comments online is, gosh, the volatility is crazy. The market's so choppy. One day it's up 500, one day it's down 500. Sometimes that up and down happens in the same day. And what's happening is they're getting chopped around. They're up a little bit of money and then boom, the market tanks and they lose money, or they're shorting a stock and then the market rips higher, etc. and so forth. So we're going to talk about not only how to read the market better, but also how you might want to adjust your approach to the market, how you might want to adjust your management strategy, etc. and so forth, the types of trades, all of those things, so that you don't let this market chop you up and down. Guys, you need to be a great trader. You need to know how to make money in all market environments. Now, I'm not saying you're going to make money in every single environment because, well, the market can be challenging sometimes. However, you need to be able to make money in most market environments, okay? And there will be a few here or there that trick you once in a while. But generally speaking, great traders, professional traders can make money in just about any market. So today, we're not only going to talk about the market, the volatility, the current conditions, but how you can mitigate that with certain types of patterns as well as management strategies. All right, so if you like these videos, please click that like button, hammer that subscribe button. I am Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is when the market speaks the loudest. I thought this was a very appropriate topic because one of the things we've been dealing with over the last 2-3 months or so, maybe more, is volatility. I'm going to say probably since Thanksgiving, the volatility has been pretty impressive. And due to that volatility, a lot of traders are sending me emails about what should I do, how should I approach this, should I change my management, should I just stop trading, should I widen my stop loss? I mean, all kinds of suggestions, which the good part about that is they're thinking about it. The bad part about it is they're thinking about it because they're struggling. So we're going to talk a little bit about the market cycle. We'll talk a little bit about current market conditions and some things you might want to consider to help you navigate through these, let's say, challenging times for a lot of traders. But before we do any of that, we first have to talk about when will the insanity stop. And I feel a little bad. Today's really isn't that bad. It's like a garden variety when we're so used to like just watching people get crushed that when somebody's only like moderately crushed, we're like, what's the big deal, right? But that's kind of where this person is. All right. So where are we at here? When will the insanity stop? TBLT. Death by duck. Kind of an interesting name. Took my 62,000 shares of voting power and it said no. But magically 3 weeks later is just still in the stock for some reason. So TBLT, at this point, I will be happy if I can get out without losing my shirt. No, without losing your shirt, your pants, your socks, and your underwear with it. I think it's possible. My average is 57 cents a share. I could be earning an extra $3K annually in dividend income with the money I have tied up in this turd. Well, you could probably get a job at Acme, or Safeway or Fry's or whatever supermarket's local to you, because you seem to be really good at holding bags, because that's what you're doing. You're acting like an idiot and you're bag holding here. I mean, you could probably get $15 an hour for that. And by the end of the year, you'd have that extra $3K that you're talking about. So, you could own this turd, go work at the grocery store because you're already an expert at holding bags and make more than $3,000 probably. Guys, this is what dumb trading looks like. I'm not trying to be rude at all. This is exactly what dumb trading looks like. Okay. How long will it take before TBLT comes back to 57 cents? I don't know. And neither does this person. That's the whole point, right? So when you got in this and you see this line right here, I should have put a line. You see it, 35 cents right there? I don't know where this person initially intended their stop to be because clearly they broke through their stop or just didn't use the stop. But if it breaks 35 cents, it's over. Now, I can't imagine you had a 22-cent stop loss on 62,000 shares, because that would be a lot of money, right? But why would you stay in it when it broke down under 35 cents? Like, why? The chart is telling you, go away. right? This big green bar with a bottoming tail couldn't hold this stock up. It went back down to this area, tested it, and broke it, bounced and broke. This is a like perfect power downtrend. Like this is a picture of weakness right here. It's perfection. And this was yesterday. All right, I don't know what it's doing today, but it's probably not at 57 cents. All right. Even if it were or was at 57 cents, what you did here is an egregious mistake that no one should ever make, guys. Okay. So at this point, I mean, this person's got, 30 grand on the line or whatever it is. So it's craziness, right? Honestly, it's just foolish. Don't do this, guys. I think you've all done it. We've all done it. I have done it before. I told you my story about Nutrisystem in the past. And you usually get out when the pain is great enough. Oh, it's at 17 cents now. Good. That's awesome. Okay. Just don't put yourself in this position. All right. What is the biggest problem that most humans have that gets us in the most trouble? Ego. Our ego puts us in spots that we shouldn't be in, but we just can't admit our mistake. Whether it's in a relationship, whether it's at a job, whether it's having a conversation with friends about sports, whether it's stock trading, our ego is so destructive. Leave it in the closet, man. All right? Check your ego at the door, because this is the kind of shit that you're going to put yourself into if you can't take that stop loss. Okay? So anyway, sorry to hear this death by duck. But like I said, everywhere I go, there's help wanted signs, and you would be a prime fit for any supermarket across the country, man. Acme, Shoplift, Safeway, Shoplift. That's California, sorry. Safeway, Fry's, whatever you want, all right? So let's move along. Let's talk about some important stuff, even though this is probably the most important lesson you'll learn today, because bag holding is never fun. All right. The market is your guide. Right? It just is what it is. I use this phrase frequently. Don't speak to the market. Let the market speak to you. Don't tell the market what you think. Read what the market is saying. Same reason that you have two ears. Think about that for a second. When the market or a stock shows you a picture, don't twist the picture to what you want to see. Look at the picture for what it is, okay? And this is one of the things I think that's really hurting people in volatile times. They cannot accept the fact that the market isn't trending the way it used to be for the last 10 years. And this, for a lot of traders, you've only known the market going straight up. So this volatility is crushing you, because a blind squirrel's lucky, a blind squirrel finds a nut once in a while, right? A broken clock's right twice a day, so to speak. So stop, right? Push that old bias out and read the market for what it is. Why? Because the market's always right. Don't fight it. It's right. It's your wife, okay? It's your spouse. Look at the market as your spouse. You don't ever tell your spouse that, that she's wrong. That's suicide right there, okay? And that's a good way out, all right? Usually they'll just take everything you have and then you commit suicide. And you go through both pains. The market's always right. Don't fight it, okay? Right? Even a blind nut finds a squirrel. There you go. Right? So this is not a joke. The market's right. You are the one that has to sort out how you trade within the market being right. Most stocks follow the market. Like 75, 80% of the stocks. And one of the challenging aspects the last 3 months is very few, even fewer than the 20%, are on their own page. See, normally during an earnings season or in normal markets, you're going to find 20, 25% of stocks that just do their own thing. They just don't care, right? Lately, I would say it's more like 10 or 15% of stocks. Even fewer stocks are doing their own thing. So the vast majority of trader losses can be attributed to being on the wrong side of the market. Tell me I'm wrong. How often are you in a trade, looks good, and market puts in a big red bar, your stock chops out? Yeah, you're on the wrong side of the market. Now, were you wrong? Not necessarily. Maybe it was an unusual red bar that came in out of nowhere, perhaps. My point is, it's still the wrong side of the market. Okay? Even if when you took the trade, you were on the right side, it ended up being the wrong side. So trading against the trend, very costly for most traders. Being in the wrong stage at the wrong time, very costly. And there's this misconception that you must understand everything all of the time. You don't. You just need to understand the ranges. What I'm trying to get at is you're going to have some red bars that come in while you're in a trade. That's normal. You're not just going to get into a trade and the market's going to put in 10 green bars in a row. That doesn't happen. Okay? But you want to be in the type of stocks, the type of trades that a red bar here or there in the market won't destroy your trade. If you're in a stock that just mirrors the market, you better be damn good at your market call, your market bias. Someone asked me earlier today, why don't you just trade the Qs and the SPYs more often? I said, because our goal is to find something that is better than the Qs and the SPY, right? We don't want to trade the Q and the SPY because that is the market. I have to be perfect. If I trade something that's showing extreme strength, like Facebook today was showing extreme strength to the market will put in a red bar and it's not going to have a huge impact on my trade. I can get away with not being perfect. Okay, so let the market be your guide. Don't marry your bias. And again, if we don't understand what the market's telling us, what the market's saying, you have to stand aside and not trade until you can confirm what the market's telling you. Yes, sitting on your hands, and we'll talk about it later, is a position. It's a powerful position that most of you, many of you, don't use enough. I'll repeat it. Sitting on your hands is a position that many of you don't use often enough. How often have you come into the day and said, man, the gap list isn't very good today. I don't really like anything on the list. I'm not entirely sure what direction the market's heading. I'm probably going to sit back for 20, 30 minutes today. Just kind of let things, shake out, right? 9:35 comes around. You're in 2 trades. What? You just told yourself 10 minutes before the market opens, you don't particularly like the list. You don't have anything that really speaks to you in terms of a favorite idea. You're not entirely sure about the market direction, but 5 minutes into the day, you're into a trade or two. What happened? FOMO, ego, both, right? You need to say no and then go and tell somebody. Right? But on a serious note, you need to seriously say no. So my point is if you really, really don't like what you're seeing pre-market, maybe just step back, sit on those hands, maybe lock your trading account, walk away, come back at 9:45, let the market shake out. Because most of the time, you're costing yourself money when you don't have a strong opinion about the market or a strong bias and you trade anyway. Okay. For most traders, it's better to avoid the first 5 to 15 minutes anyway. Even in a good market, it's better to avoid it. But in a bad market or a market you're uncertain about, it's imperative that you do. All right. So the market's basic atom, right? 4 stages in the market, 1, 2, 3, 4. Okay. Ambivalence, greed, indecision, and fear. These are the 4 predominant prevailing emotions in the market. Okay. The easiest ones to make money in are 2 and 4, which is greed and fear. The fact of the matter is the average person, and honestly, the average trader only knows how to make money in stage 2. Greed. They only make money when the market's going up. I mean, how many people do you talk to out in the world that don't even know that you can short a stock? I'm astonished by it, despite movies like The Big Short or Wall Street or all these other movies out there and all the information you have online. They don't know that you can actually make money when the market goes down. All right, so the average person, investor, whatever you want to call them, only knows stage 2. That's when things are good, basically the last 10 years in the market. Right? You guys know what I said this the other day. The returns in the market the last 3 years. You know how obscene they are? The S&P 500 was up 30%, give or take, maybe a little 31%. 30% in 2019. It was up 18% in 2020, and it was up 31% or 30.5% in 2021. So most people that have gotten into the market over the last 3 years, they only know straight up, not a little bit up, straight up. So they have no idea how to handle the stage 3, 4 that we're in right now. We are literally in a daily stage 3, stage 4 on the daily chart of the NASDAQ 100 and the S&P 500. So people have no idea how to handle this because they've only known this, greed. All right. And the hardest stage to trade is stage 3. Right? See, stage 1, nobody cares. It's ambivalence. You're just sitting back, narrow range, light volume, low volume, etc. Right? But stage 3 is that wild and whippy, volatile tug of war. The buyers say that we're going to go higher. The sellers say we're going to go lower, and just butting heads. And you really don't know. And for a while, no one knows, right? You're just chopping back and forth, okay? So the problem is is that's where we're at. And realistically, technically, we're actually in an early stage 4, okay? Excuse me, right? So most people have only been used to greed, so they don't know how to take advantage of fear, okay? Thank you, Farrell. All right? And when you're in this transition between 3 and 4, you have to be nimble. Why? Because during the transition, there's less follow-through, which is exactly what we've been seeing because the volatility is so crazy. Don't worry, we're going to take a look at a chart of the current markets in just a second, all right? But this is what we go through, and these are the emotions that you go through. Unless you learn how to handle each one of these stages, you're only going to be able to make money in stage 2. Well, that's 25% of the time, isn't it? Thankfully for us, it's more than that because the markets are actually up most of the time, okay? Another comment, and this is a side comment, this isn't just to do with trading, this is a general market comment. Guys, do you know historically the market is up 72 to 73% of the time? Almost 3 out of 4 years. And over the last 40 years, the market is up nearly 80% of the time. I think now there's a method to my madness here. So the market over the last 40 years is up 4 out of 5 years. Traditionally 3 out of 4 years. And you have one down year and people are like jumping off bridges. Huh? The last down year the market had was 2018. It was 4%. Minus 4%. And then it went up 30%, 18%, and 30%. And people are literally looking to like sell everything they own when the market goes down 5, 10%. Get a grip, people. Get a hold of yourselves. You want to know why you're broke? Because you're too jittery. There's something to be said for when there's blood in the streets, it's time to buy. The market doesn't go down much, so when it does, take advantage of it because it's going to go back up. And the day it doesn't go back up is the day we live in the 12th century. Everything goes away. Everything's tied to the stock market. Everything. Okay? So this cycle happens in all time frames. 1-minute charts, daily charts, weekly charts, monthly charts. So your goal is to match the stage on the higher and the lower time frame. All right, I'm not going to get into this. This is a detailed position that we have in professional trading strategy. We'll probably spend 30 minutes just on 4 or 5 slides. I'm going over the basics. It's the only movement possible. So when you're in a stage 2 in the daily chart, you want to try to be in a stage 2 in the 5-minute chart. Match the time frames, take the trade. Okay, but the key is knowing where you're at in the cycle. If you don't know where you're at, how are you going to take advantage of the cycle if you don't know where you're at? Right? It's kind of like professional athletes or basketball players, and they don't know how much time's left on the shot clock, and then they get a shot clock violation. Well, you need to know where you're at. Okay? Same. You need to know where you're at. All right? So, this is a recent chart of the NASDAQ 100. Okay? QQQ from, I don't know, a couple weeks ago. Whatever it was. Early February. Right? So, note. Stage 2 uptrend, and then what do we have? Pivot high, retest lower high, lower high, lower high. So we're in that stage 3. This is a daily chart. Go back, go back, go back. Remember I said stage 3 is a very choppy, whippy, wild stage where buyers and sellers are going against each other. The buyers say we're going higher. The sellers say no, we're going lower. It's very choppy, very volatile. Okay? If we take a look, this is exactly what we're seeing here. And basically, it started here in October, but then we had this huge run back up. Okay? Chop, 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 chop. Once we break 380, right? So here's a good shorting opportunity. Aggressive, but good. Okay, because why? We failed the last 3 times we tested 400, 405. So we're probably going to fail again. And this is a smooth move up, so it gives you void below. But what happens? Green bar comes in here. We try to bounce. We can't. That's bearish. Another green bar comes, a huge bottoming tail. We bounce. And then this happens. So when you break 380, oh boy, you can be nothing but bearish at that point. Nothing but bearish. And then you slice through the 200 period moving average, this red line. And then you break the next area of support is 350. So the first area of support is 380. You break this, you're already concerned. You break 350, now you're really concerned. Okay, so then you get a big ass bottoming tail on huge volume. Market bounces. Now what do you get? Green bar, bottoming tail, which is what? Buyers stepping up. Guys, visualize this for a moment. this bottoming tail was actually a wide range red bar. At one point in time, that bottoming tail was a wide range red bar. What happened? Came all the way back up, left a tail. That means there was a fight between the sellers and the buyers won that fight. Next day, market gaps up. That little dot right there, that's the next day. That's pre-market. So it's 9:10, 9:15, 9:20 in the morning, and you're like, okay, market's at 370. What's the bias? The market is opening at 370 after 3 pre. What's your market bias? Talk to me. I need audience participation. What is your market bias today? It's pre-market. All right? Pre-market. So we don't know. It's not 9:30. We don't know what's going to happen. You're trying to set up your day, trying to sort out what direction you think we're going to go today. All right? And most people are saying bearish, choppy, bearish, 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 bearish. Everyone's saying bearish except for one person. Okay? Other person says long to sideways. But I would say 90% of the answers are bearish. Now, why? Why should we be bearish on the market? I agree with you, by the way. We should be bearish. But why? Well, we're up one huge green bar, two huge green bars, and then we have a big old bottoming tail, which is extremely bullish. And then we gap up into a little bit of supply, right? A little bit of supply right there. Okay. We're at about a 50% retracement. We're gapping up after 3 huge days. And we're at about a 50% retracement. You could argue there's some minor price resistance to the left here. All of those things suggest to me we're going to go lower. It's nice that we're above the 200 MA. At that moment in time, we weren't above the 200 MA. So this picture was taken a couple days ago. But anyway, okay, this is where sellers are supposed to step up. You're 4 days up into some minor resistance, okay? Guys, Unmall has UAA 1741 by 1760 short. Anyway, I'm looking at this going, I think we go lower. So I'm going to go in today. I'm going to have a little bit of a bearish bias. Despite the gap up, I'm going to have a bearish bias. So what happens? There's the gap up. We're on a 10-minute chart now. Same day, but now we've drilled down from the daily to a 10-minute, okay? Market opens, goes a little lower, puts in a bottoming tail, and then big wide range red bar comes in, okay? And then the market starts to go higher. What's the expectation up here? What do you guys think? What's the expectation? So we're 30 minutes into the day, something like that, 40 minutes into the day, okay? What's the expectation? I don't know, get you thinking. I'm thinking double top. If I drill down to a 5-minute or a 3-minute or a 2-minute, I'm thinking double top. I mean, I'm looking at this move from 362 down here all the way to 370. Big red bar comes in, buyers come in. It's a very bullish sentiment, but we're already up so much. We're up 4 days. We've been moving up since 362, and if I go down like to a 2-minute, 5-minute, I'm getting a little double top retest. So I'm looking, personally, I'm looking for a pullback here, right? Sure, anything's possible. We could rip higher. We could go sideways, but I'm looking for a pullback here. If it goes sideways, correction through time, then I'll look to go higher. But we should put in a little bit of a V top right here, okay? And hopefully go lower, right? We should put in a little bit of V top and hopefully go lower. So what really happens? Oh, what I thought happens. That's what should happen, right? Sellers come in, they retest the opening, bounce, pull back, and what's the expectation now? Now what's the expectation? So we got what we wanted over here. What's the expectation now, right where this arrow is? Lower. It's got to be. It retested the high of the day and could not put in a higher high over here. So we retested the high. That's bearish, right? We retested and could not put in a higher high, bearish. Okay? We drop, put in a lower high right here, a lower low right here, and a lower high right here. So here's a lower high right there, equal high here, lower high here, lower low here, lower high here. This is the beginning of a nice controlled downtrend. So, what am I going to be looking to do right now? Buy every stock I see? No. I'm going to be looking at my short list and going, hey, what looks good on my short list? Right? What looks good on my short list? Okay? Shit. Then this happens. It pulls back, bounces, pulls back, and bounces. And it ended the day right there. Now, I'm commenting on this for a couple reasons. One, because earlier I said our market bias is very important. Sometimes we are wrong. But most stocks move with the market, and recently even more so than normal, right? 75, 80% is normal. Lately, it's like 85, 90%. So if you're wrong on your market bias, shoot, we're in trouble, okay? So sometimes we're wrong. The expectation was lower prices, pulled back, and even here, you pull back, you're like, okay, well, now that it failed, right? It failed this little sell setup. Maybe it's going to go higher. And then you think, oh, maybe I'll go long, even though you shouldn't. Maybe I'll go long. And then it shakes you out and then goes higher. Okay? So when you look at this, this is tough. You did 100% retracement here early in the morning, right? So you pulled back from 370 to 366. Then 100% retracement back to the high of the day. Then 150% retracement back down to 364. Then an 80% retracement back up to here. I mean, you are all over the place. All over the place. For a moment, you buy a long and it goes up and you're like, yeah, I'm looking good. Boom. Then you short something on this little pseudo sell setup. Boom. Get stopped out. The point, sometimes we're wrong. Sometimes we have the right idea and we end up being wrong, which is okay. We're human. It's why we have stop losses. Other times, it's just really hard to read the market. Okay? Other times, it's really hard to read the market. Yeah, but here's the thing, Bertle. There is. You're absolutely right. If you want to draw a trend line on the long side, but you're also 4 days up after a big gap up. It's over a 1% gap on the fourth day up, right? So this would be an area where you'd expect the bounce at 364. That's not the problem. The bounce at 364 isn't our concern. The failure at 366 is, right? It should. This is an area where it should break the trend line because it put in a double top retest and failure, put in a lower high. So yes, it held the uptrend line here. Good. But you're also 4 really extended days up. I mean, the market went from 350 to 370 in 4 days. Guys, this isn't Tesla. When the market goes up $20, in this particular case, what's that? 7%? Somewhere in the 7% range in 3-4 days? Again, this isn't Tesla. This is the QQQ. So my point is I would expect a failure here, especially after the double top here. So the bounce down there at 364 wasn't the issue. Okay? And then you would even more so expect it because the bigger picture tells us what? We're not as strong as we used to be, are we? Repeat. The bigger picture daily tells us we're not as strong as we used to be. We broke 380 support. We broke 350 support. And that was wrong, by the way. The market went from 338 to 370 in 4 days. Not 350, 338. The market went up $42, guys. That's over a 10% move. That's like a 12% move in 4 days. In what? An area that we're expecting prices to fail. Lower high, lower low. Lower low, lower high. That's the expectation. Lower high. Guys, where are we today? We're back down here in the 350s range today. 2-3 weeks later, we're back down here. So what did we get? A failure where we were supposed to get the failure, just not on that day. So our overall sentiment was dead on correct. But every once in a while, you get chopped around. And this is what makes the transition from 3 to 4, stage 3 to stage 4, so difficult. And that's exactly where we're at. One lower high, one lower low, one lower low, one lower high. We're getting close to being in that stage 4 downtrend. Okay? And again, it's what makes this so tough. So, the goal in a perfect world, right, and we don't live in one or trade in one, is this. You have a stock, gaps up, pulls back, double bottom, goes higher, chops around, goes higher, chops around, and then this is the goal. See the market right here just tank. 1, 2, 3, 4, 5, 6, 7, 8, 9 bars in a row down. The stock, what does it do during those 9 bars down? Nothing. It holds the high of the day. Earlier we were talking about when you see a FANG stock like Facebook, Apple, Amazon, Google, whatever, showing crazy strength in the market, you have to find a way on board. Well, this is an example. It's not a FANG stock, but this is an example of where the market gets trashed on. And this stock holds the high of the day. The second it puts in a bottoming tail and goes green, the stock rips. That's the kind of stocks we want to find in a perfect world. The problem is finding these every day is tough, right? When you have a gap list of 15 ideas and none of them do this, that's a tough day. Because usually we'll find 2 stocks or so, 3 stocks that are kind of on their own, right? And when you find those, they're easy to discern. And then you can take them and not care what the market does in a volatile environment, okay? But you can see right here, this is somewhat a picture of what we're seeing now, right? Market gets hammered, market bounces back up 70%. Find the stocks that don't give in to the market during the pullback. Let's try it again. What about this? So now we have a stock that's in a downtrend, okay? See the blue line there? Little trend line there? Drops, 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 drops. Big bottoming tail, bounces, retest. Next day, gaps down. This is the day line, daybreak. Gaps down, puts a massive, massive green bar and a higher high. So we already have a little retest. We already have the retest. But the gap down that bullies technically is a double retest. And it puts in a higher high. And it breaks above the trend line, and it breaks above the declining moving average. So we're already looking for a way to get on board. What's the market do? Well, the market gaps down that day. So does this stock. Market bullies. So did this stock. Okay. This is a 5-minute. This is a 15-minute. So match the times. Match the times. Okay. Match the times. So when the market sells off, right around 11:15, what's this stock do? It's ahead of the market. It's already bouncing before the market. But note, the stock pulls back about 60%. The market pulls back 150%. That's the low of the day on the market right there on the red line. That's the low of the pullback. The low of the day over here is the pink line of 44.80. It pulls back to 45. Big difference there between a 150% pullback and a 60 or 70% pullback. Market puts in a bottoming tail on volume. This stock is already going green before the market goes green. Okay? Got it? The stock is already going green before the market goes green. So there's a possible entry. Is it slightly more aggressive? It's slightly more aggressive, but what do we have going for us? Triple bottom retest, higher high, break of the trend line, break of the moving average, and a pullback. That's a lot less than the market. So the market bounces, albeit not that great. Stock takes off. If you didn't want to take it because you thought it was too aggressive, that's fine. Puts in a higher high, pulls back to support, buy it over here. Put your stop down there, boom. Okay? So this is what you're trying to do when you're looking at the market compared to the stock. You're trying to read the correlation, the relativity, so to speak, between the stock and the market. And when you find something that's clearly in a good spot, maybe ahead of the market, but also in a good spot, like this is technically a triple quadruple bottom. This is a transition on a micro time frame. 15-minute transition from a stage 4 downtrend to a double triple bottom stage 1 retest failure back into an early stage 2 uptrend. And the market gave you that, and this stock led it. Okay? All right? Would you consider that an ending bar? Well, in this case, it has to be. Right? It has to be. Because it put in a green bar before the market did. And then the market put in the bottoming tail. If you didn't feel confident about it, then wait. Wait for it to put in a higher high and buy the next pullback. Okay? Here's another example. My back is killing me. All right. What do we have? 2-minute stock, 2-minute market, daily stock. First things first. Stock's in a bit of an uptrend. Gets a little choppy here. Okay? Gaps up, and we do have some junk at like the 166 area, right in that range. Okay? So we know we don't have a ton of room, but we have enough. First thing we see is the daily of the stock. Stock gaps up, market gaps up. But drill down. First 3 bars of the day for the market, red, bottoming tail, bottoming tail. So buyers are stepping up, but they're still red, meaning it's still putting in lower lows, right? We're still getting lower lows here, okay? But what does the stock do during the exact same 3-bar period? The exact same 3-bar period. Green bar, consolidate, consolidate at the high of the day. Market puts in bottoming tails, which leads us to believe higher prices because bullish market bias. Market leaves 2 bottoming tails while the stock consolidates at the high of the day and the market's at some support. You're probably going to get higher prices. The stock's already consolidating at the high of the day. This is outstanding market timing. You have a daily chart that allows you back room to 166 or so. You have a stock that's at the high of the day giving you a beautiful 4-bar play pattern. I mean, just perfect. And you have a market that really looks like it's going to bounce after multiple bottoming tails at support. It's beautiful. It's great market timing. That did what you wanted it to do. But note, when the market did pull back and the stock got near resistance, it did pull in. So what's the lesson here? Yes, it was great market timing, but you had to know what the target was. And you also had to know when it got there, you probably need to peel some off. Doesn't mean you have to sell your whole position, but you have to take something off. It's at resistance. And the market pulled back a little bit here after 4 or 5 bars up, chops around. What happens? So did the stock. So yes, the stock is showing strength, but it doesn't have insane, silly strength to the market. And this never stopped out. I mean, it pulled back above break even the whole day. Okay, but know where your targets are too. Knowing the market bias and the pattern's one thing. Know where your target is. Now, we're back to the market again. What do we have here? Overlapping bars for 4 days in a row. What's the bias, guys? Pick any one of those days and tell me the bias. Pick any one of those days. I don't care which one you pick. Any one of those 4 days. What's the bias? Yeah, ask Nostradamus. I don't know. It's just tough. You just don't know. Sideways? Hope for follow-through? Sit on hands, perhaps? This was a pain in the ass, those 4 days to trade. And to be fair, so was that bottoming tail day. Why was that bottoming tail day a pain in the neck? Because it actually did what we wanted it to do. It gapped up and went red. That's exactly what we wanted the bottoming tail day to do. And then late in the day, it goes green. Ruins all your trades. I'll show you in a minute what I'm talking about. Well, then you get a gap down, and it actually moves lower. So the first day, not too bad. Gaps down under a bottoming tail, very bearish, has room to drop. Good. Next day, opens flat. Moves all the way up, pulls back a little. Next day, gaps up. Nope, opens flat. Pulls back, moves up. Next day, opens flat. Actually, no, it opened a little bit down, and then moves all the way up. Oh, it's a pain in the neck. These are days you need to wake up and say, it's an inside day. I do not have a strong bias. Sit on your effing hands. Don't say it, do it. Why am I saying this to you? Because one of those days, I remember it very clearly. I told you guys I remember it clearly. I said, guys, I don't like my gap list today, and I don't have a strong market bias. I'm going to sit back. In fact, I even typed it on StockTwits. Be careful today. What did I do? I traded, and I lost an hour and a half. I lost $1,500. So think about that. Pre-market, you tell thousands of people, don't trade today. It's very tough. Unless you find something so perfect that God himself would take, don't trade. Type it in StockTwits, type it in the chat room, type it on Twitter, type it everywhere. Careful today. No, I'm good. I'm going to trade anyway. That's just poor management, right? That's just poor psychology. What's the lesson here, though? Listen to your pre-market self, because your pre-market self doesn't yet have FOMO, right? The market hasn't opened yet, so you haven't, that devil on your shoulder isn't nagging at you yet. Listen to yourself. Listen to the objective person, which is the person before 9:30, because after 9:30, you get a little ahead of yourselves. The need to be right. I have to make money. Guys, sometimes not losing is winning. You know where we learn that really well? In credit spreads. To not lose is to win. To not lose is to win. So now I lost $1,500. So to start the next day, which was a narrow range day, I have to make up $1,500 plus get what I need to make that day anyway. So now you got to go make $3,000. Right? And you could have saved yourself the $1,500. Everything spoke to you. The chart, everything said, don't trade today. How often do we do this? The answer for most traders is too often. Tell me I'm wrong. What if every month you could take your 2 worst down days and eliminate them? What if? How much money do you think you'd save yourself that year? Just every month, take your 2 worst down days and eliminate them. How much more money would you have? How many more R's would you have? Probably a lot, right? Because many of you are having between 5 and 10 down days a month. As you get better, you'll have fewer, right? But you're having that 5, 6, 7 down days a month, and 2 of them are nasty. Ooh, they're ugly. They're 3 to 5 R down. You could save yourself 7 R a month, 8 R a month, right? Crazy. Think about it for a second, and then go back and look what your worst days were and how that day planned itself or materialized out. Meaning, did you tell yourself pre-market you shouldn't trade that day? Was it an inside trading day for the market? So you have yesterday's high and low, and today we're inside that range? Those days are hard to trade. I'm not telling you ever you can never trade. I'm just saying on those days you need to be so much more careful, so much more precise. Okay? So what if you have trouble reading the market? What if not many stocks are on their own page? What if it's an extremely volatile market environment? What do we do during these events? Well, trouble reading the market, look for relative strength or relative weakness, and if you cannot find it, you sit on the hands, you just stay out. It's what we just talked about. If you can't find strength or weakness, like true strength and true weakness, sit on your hands, take a step back, walk away. Do not let your ego trade for you. Not many stocks on their own page. Well, be confident about your market bias, all right? If not, sit on your hands. So again, if you're finding that you don't have a lot of stocks on their own page, then you need to be really, really right with your market bias. And some days that's easy, right? Some days we're good at our market bias. It's very easy to predict the market. Some days it's not. So if you're in both of those scenarios where it's not easy to predict the market, where i.e. trouble reading the market, and there's not stocks on their own page, back to sit on hands. Bruh. Right? When in doubt, stay out. Extremely volatile market environment. What we've seen recently. Be nimble, scalp trade, let's do move stops quickly, okay? Use extra wide stops and try to add back later, or sit on hands, right? Be nimble, try to get in and out, which is kind of the approach that I've taken. I'm just going to get in, get out, move my stop up. The goal here, not to lose, not to have a nasty down day. My up days might not be as big either, but neither will my down days. See, it's okay to have a 2R down day or a 3R down day if you're doing 3R all or nothing, and sometimes you make 6R or 9R. But if you're not getting those gains because of volatility, you're getting shaken around, then you can't have a 3R down day because it's going to take you a long time to get it back. Or use extra wide stops and try to add back when things move into your direction. That has actually been the approach that Unmall has taken. So we've actually used two completely different approaches. He's like, you guys are in Hood today, looking really good, by the way. He used a 30-cent stop loss, which is really huge for that stock. Should he? I mean, I shouldn't say should have. He could have used 10 or 15 cents, and you guys would have made 4 or 5 R. But the market volatility, well, you used 30 cents, so now you're up 1.5 R. It's a big difference. 4 R, 1.5 R. But you're not going to lose either. You're not going to lose either. Okay? So either one of those, and if you can't sort that out, sit on your hands. Okay? You could also reduce your risk level. That's a possibility as well. Okay? Can we go by adding? No, Constantine, you go by risk level. You don't just say I'm going to add 100 shares because it's 100 shares. You look at why are you adding 100 shares? Are you going to add half lots, quarter lots, full lots? But I wouldn't just say add 100 share lots. No. I try to add full lots, especially if I'm reducing my risk, because why not maximize the gain, right? All right, so this is the day we talked about. This is not easy. Gap up over here even. Gap up, pulls back, I don't know, $6? Does 100% retracement back to the high of the day. Pulls back another 30% and then does another full retracement. Just even this day is challenging to trade because you're gapping up and you're thinking, okay, well, maybe we'll have some higher prices. And if not, we'll pull back a little, then we'll bounce. No, we don't pull back a little. We pull back a lot and then bounce a lot. Same here, gap up, pull back, 100% retracement, 150% retracement, 80% retracement. I mean, we're all over the place. Okay, so getting those trend days is tough. And the problem is ultimately you end up being right, but you've been shaken out before you have an opportunity to make money, right? So some people say, hey, I was bullish on this day, but they got shaken out on this pullback, which is why trading the first 30 minutes is tough. Or right here, maybe they go long and all of a sudden they get shaken out with that and then it goes higher. How about this? You guys remember this? I do. This is frustrating. Thankfully, I scalped out of this for just under 2R. But what if I were doing end of the day hold on JP Morgan on this day? This is a pre-market consolidation. When the market opened at 9:30, it ripped. We were in it. Okay, we got in a little bit later than this slide, right around 155. So a little bit later than this, okay? Stop loss is down here, 154.25. Guys, the stock went to like 158.50. Hello. It went like $4. $4 on a 50-cent stop loss. They're like 8 to 1, 10 to 1. And then what happened? It ends the day up like 1 or 2R. You were up 8 to 10 to 1, and this thing just gave it all back. This is what I'm referring to when I say these environments can be very frustrating, particularly for certain types of trade management. See, if you were scalping here, or even doing 2 or 3R, you would have made a lot of money. But if you were trying to do end of the day hold, which typically is a very profitable management, you would have been so frustrated it wouldn't even have been funny. So annoyed by this, right? Guys, you know how rare it is, traditionally speaking, for a stock to go up more than 3 or 4R and stop out? This didn't stop out, but you get the point. You know how rare it is? When I mean rare, a stock going 3 to 5R and stopping out probably happens 2% of the time, 1%, 1 to 2% of the time. Yes, for every 100 times it happens, 1 to 2 times will a stock that's up 4R come all the way back and stop you out. And the times that it usually happens are if there's some random news report that comes out. This wasn't that. This was just the market. Another example. How about this? JP Morgan again, a few days later, a week later, breaks above the resistance line. Goes higher, pulls back, choppy area. I'm not sure you want to buy it there or not. Goes way up, wide range bar, igniting bar, range expansion bar, breaks above the high, it pulls back. World's best buy setup? No, but solid, right? Not the world's best, but it pulled back to an area where buyers stepped up. big time before. It even retested that area and went higher. So you're in here at like 158.25. Your stop's like 157.75, 50 cent stop loss. The thing goes up to 159, so you're up about an hour and a half. Done. Market tanked. Took JP Morgan with it. What's the point? You're up maybe 1.5, 2 hour. Market turns out into a full stop. This is what I mean when we go back and we talk about you have a choice. Now, in this case, it wouldn't have mattered on one of these choices. You can be nimble and scalp. You can use extra wide stops. Now, in this case, the market really rolled, right? It gave it up pretty good, and it wouldn't have mattered how wide your stop loss was. Like, it was just going to take you down, and that's it. Okay? So nothing is perfect, but you can mitigate these environments. You can sit on your hands. You can try to just scalp in and out quickly, which you have to be pretty good at, okay? Or you can give them really, really wide stop losses, okay? Your management, though, needs to be maybe a little flexible. So in basic summary, you're going to need to develop a daily bias. Scan according to the bias, but don't marry it. But if this isn't possible, sit on your hands. If you cannot find a bias because it's one of those 4 super narrow range inside days and you can't find relative strength or weakness, sit back. Trust me, trust me, trust me. You will thank yourself later. All right? There's this, I don't know why it exists with people. It's very strange, the human psyche. What's the first thing that people say when they come back from vacation? The first thing traders say, I see it all the time. Oh, I probably missed the best week of the year, didn't I? Right? I mean, it happens all the time. Someone comes back from vacation. Oh, how was last week? Oh, it's probably the best week of the year, wasn't it? Why would that be the first thought in your head? You're not even a great trader, and you're coming back thinking, I missed the best week of the year, right? The funny part is if you were in any of those stocks, you probably would have gotten out of them anyway, because you're not a great trader or a great trade manager to begin with. So even if it was the best week of the year, no matter what, you were probably going to sell too soon anyway, right? That's why you're making that comment. It was probably the best week of the year, right? On top of all of that, we have this idea in our mind that for some strange reason, this is where traders and people in general lack objectivity. Let's just say hypothetically, you're up 70-30, okay? Or 60-40 for a new trader. Maybe there's 12 out of 20 days you're up. Okay, for a new trader. A good trader should be up, 15 plus days a month. Okay, but you miss a day and you immediately think to yourself, oh, it's probably a good day that I missed. Why? Why wouldn't you just look at the market and go, you know what? That looked like a pretty narrow range inside day. I'm glad I didn't trade that day. I mean, you have 50-50 odds for most of you new traders whether you're going to make money that day or not. But you automatically think the days you miss had to be the best days. You never think, gosh, it was probably the worst day of the year. I'm glad I missed it. Just stop that. Be much more objective, okay? So, one last quick comment, because we could do a whole lecture just on this. Can we ever go against the trend? Yes. Parabolic climactic patterns, high-level morning gaps, when the market gets too extended in one direction or pulls back to an area of significant support. This is a lecture in and of itself. And guess what? Wink, wink. I might do a lecture on this. Okay? The overall idea, though, is to stick with the trend of the market. When you do this, your odds of having a successful, profitable trade are much higher. One of the biggest mistakes that novice traders make is going against the market and not using multiple time frame analysis. Don't trade in a vacuum. Lastly, the overall goal, the overall idea, the overall goal is to know when you can go against the market and have a trading plan that's prepared for all market environments. Remember, if there is ever a time of uncertainty, a situation where you are unsure of what to do or cannot read the market or a specific pattern, then you must stand aside. Let things sort themselves out until you're able to discern the trend and find a high odds pattern. Being a professional trader is as much about knowing when not to trade as it is about knowing when to trade. The only difference is the ability to stop yourself from doing so, which was last week's lecture on mindfulness. Yes, full circle. Mic drop, okay? You need to know yourself well enough. Why is that important? Because if you're looking in the pre-market and you go, there is nothing I like, but you can't be trusted at 9:30, walk away, take a walk. Come back at 10:30. Don't come back at all. If you know you can't be trusted, then don't put yourself in the position to not trust yourself. It's like, I know I'm a full-blown alcoholic, but my friend's at the bar and I got to go say hi. No, ask your friend to meet you at Denny's. Or just don't go. Don't put yourself in that position. But you'll do it anyway, because you know better. YOLO. You diamond hands. Don't do it. I'm telling you, don't do it. It's the same as when I tell people not to risk lots of money when they're new. Risk $5 or $10 per trade, but they know better. And then they get featured on When Will the Insanity Stop? Know thyself. Okay, so I hope you guys learned a little bit about how to navigate difficult, volatile markets and some of the things you can do to help mitigate those environments, particularly sitting on hands when you're unsure. Hopefully it will help make you a little bit more money as a trader. I am Jared Wesley of Live Traders. We'll get back at it again next week.